Hey guys, it's Marco, back again with another crinkly black shirt, and today we're talking about something absolutely insane. If you've heard anything about GameStop recently, you'll probably know that their share price is skyrocketing at the moment. Now, there's a lot to unpack here, so without further ado, let's get right into it. Now, to fully understand what's going on here, there are a few things you need to know about, the most important being short selling. Now, short selling or shorting a stock is a way to make money when the stock price goes down. Usually when you buy a stock, you want it to go up in value so that you make money. But when people think a stock is going to perform poorly or even crash in the short term, then they might short it so that they make money by the stock price going down. So how does that work? Well, it's a little bit complicated, so I'm going to be making a full video just on short selling, but here's a basic explanation. A short seller starts by essentially borrowing a stock from a broker with a promise to give it back later. They then take that stock and sell it to another broker. Then later, when the stock price is hopefully lower, they buy that same stock again at a lower price and give it back to the original broker, and they profit the difference. For example, let's say a particular stock is currently trading at about $100 a share. A short seller might borrow that stock from a broker and sell it for $100, anticipating a crash in the near future. Next month, that same stock might only be selling for $50 a share, so the short seller buys it again for $50 and gives it back to the original broker. They profit that $50 difference minus interest charged by the original broker for the privilege of lending out their shares. Now, between the time that the short seller has borrowed that original share and given it back again, they have what's called a short position. And when they give back that share, they have closed their position. So one of the weird things about short selling is that there can be more short positions than there are shares. Let's look at an example of how that might work. Let's say I borrow a share from broker A and sell that share to broker B, hoping to later buy it back at a lower price. In the meantime, broker B goes and lends that share out to another short seller who sells it on to broker A, once again hoping to buy it back at a lower price. Now, broker A has gotten back their original share, but broker B is still owed a share from the second short seller, and broker A is still owed a share from me. So there are two short positions that are currently open, even though in this example there's only been one share. Now, this isn't necessarily a problem if everyone is buying and selling shares freely, because everyone will get the opportunity to buy the shares that cover their short positions. However, when people aren't selling shares, this can create what's called a short squeeze. Now, before we get into that, let's take a look at GameStop. GameStop, if you don't already know, is a brick and mortar video game business. They sell video games, but they only have physical locations, not an online store. In the past several years, brick and mortar retail sales have been slowly declining as people shop online more and more. So GameStop's share price was already slowly declining over a period of several years before 2020 hit. As we all know, 2020 was a terrible year for brick and mortar retail sales as people were terrified of going outside and did as much of their shopping as possible online. So GameStop was really struggling and their share price fell to below $4 a share. Everyone expected them to go bankrupt, and of course when a business goes bankrupt, their stock price will usually crash down to almost nothing. So a lot of large institutions like hedge funds opened up short positions against GameStop, waiting for it to crash. However, GameStop didn't go bankrupt immediately and managed to hold on for quite a while, even seeing some gains. This was probably due to a few reasons, such as people being slightly more confident to go outside again, and GameStop appointing a new board of directors that had experience with online sales, which is exactly the type of business model that they would need to transition to survive in 2020 and beyond. Of course, this made those big hedge funds nervous because remember, with a short sale, your profit is reversed. So if the stock price goes up, you're actually losing a lot of money on top of the interest that you have to pay for borrowing those original stocks. So what did those big hedge funds do? Did they realize their mistake and close their short positions at a loss? No, the exact opposite. They doubled down. Now you might be thinking, why would you short a stock that's going up? Wouldn't you just lose more money? And the answer is usually yes, except those hedge funds have billions of dollars at their disposal. And with a small market cap stock like GameStop, that means that if they pour enough money into it, they have the power to manipulate the price of the stock. Now, basic supply and demand tells us that if there's more of something, the price will usually go down a bit. So with stocks, if there's a huge sell-off, you'll usually see the price dip. So remember, with short selling, the first step is borrowing the share from a broker, and the second step is selling it. So when a lot of short positions are opened at the same time, you'll often actually see the share price dip a little bit. So what these hedge funds did is they opened up a lot of short positions at the same time to try to suppress the share price from going up. And they didn't just open a few thousand, they opened millions of short positions. As I'm filming this video, there are currently more than 70 million short positions still open on GameStop. And while there are almost 70 million outstanding shares, a lot of those are actually held by insiders that can't sell their shares very easily because of tight insider trading regulations. So there are only between 20 and 30 million publicly traded shares of GameStop. As I mentioned earlier, this isn't necessarily a problem if everyone is buying and selling shares freely, but that's where Reddit comes in. There's a subreddit called r/wallstbets, and like the name suggests, they're not about carefully considered investments, but rather wild speculation and crazy gambles. People on Wall Street bets often become millionaires overnight or lose everything they have, but occasionally, very rarely, there's actually a good idea that pops up. And someone on Wall Street bets realized what was happening with all of these short positions and realized there was a massive opportunity. They realized that if enough people bought GameStop shares and refused to sell them, the demand from these huge hedge funds trying to close their short positions would make the price of GameStop skyrocket. So that's exactly what the people of Reddit did. They piled into GameStop, creating a buying frenzy that drove up the price of GameStop to the point where these huge hedge funds started losing quite a bit of money. Now, if you're shorting a stock and the price climbs above what you originally sold it for, there are two main problems. The first is that you have to keep paying interest to the broker that you originally borrowed it from. And if this goes on for too long, you'll end up paying more than you could ever make from shorting the stock. The second problem is what's called a margin call. Now, once again, it's a little bit complicated and I'll go into it in more depth on my video about short selling. But essentially, when you short a stock, you have to put some sort of security against your position. This security, which is often a sum of cash, has to make up a minimum percentage of your short position, which is decided by the broker. And if the stock price goes up, meaning you're making a loss, that sum of cash you originally put down might not be enough to cover your position anymore. In this instance, the broker can do what's called a margin call, which essentially forces you to put down more cash to cover your position. So in the case of GameStop, when the price started going above what these hedge funds originally borrowed and sold the stock for, they had two options. Either they put down very large sums of cash to cover their positions, or they try to cash out immediately and lose money but close their short positions. So in the case of GameStop, when the share price started climbing above what these big hedge funds originally borrowed and sold the stock for, they had two options. Either they start putting down increasingly large amounts of money to cover their short positions and continue paying interest, or they buy the stock at a higher price, losing money, but close their short positions and avoid losing even more money as the stock price continues to climb. For most institutions, cutting their losses early was the better option, so they started trying to buy this stock to close their positions. However, the people of Reddit refused to sell. This is creating a massive feedback loop as these huge institutions are getting more and more desperate to close their short positions and stop bleeding money for their investors. And the only way to do that is to continue offering more and more to buy into a shrinking pool of shares. This is what's known as a short squeeze, and it's not the first time that this has happened, not by a long shot. The most notable short squeeze was probably during the global financial crisis, when Volkswagen stock shot up dramatically for a brief moment, becoming the most expensive company on the stock market. Because this has already happened many times before, we already know exactly what's going to happen with GameStop. Eventually, we're going to reach a point where people start selling off their shares, taking their massive profits, and subsequently causing the share price to crash back down again. So, is there still enough time to join in and become a millionaire overnight? Well, maybe, but maybe not. The thing is, while we know what the general trajectory of GameStop is going to look like afterwards, nobody knows exactly what's going to happen with it in the short term. At the moment, it's trading just under $400 as I'm filming this, but it might shoot up to $1,000 or it might crash as soon as I stop filming. nobody knows exactly when it's going to crash or what it's going to go to before it crashes. So my general advice would be that it's good to be aware of these sort of things and to understand why stock prices can just suddenly jump up by insane margins, but just to continue with reliable investing strategies and not worry about missing out on these sort of insane gains. Understand that at this point, any money you put into a stock like GameStop could just be wiped out the next day and you could lose everything. Investing in the stock market is a long-term game, and the best way to come out ahead is to be consistent and continue investing in a well-diversified portfolio. Well guys, that's it for today. If you found this video informative, please give it a like so YouTube shows it to more people. And if you want to learn more about the stock market and your personal finances, feel free to subscribe for some more content. Thanks guys. So I just wanted to show you guys this. I wanted to get this video filmed quickly, but of course my camera wasn't cooperating, so I had to improvise and film on my phone instead, but I don't have a tripod for my phone, so this is what we had to come up with. It's an empty wine box with my phone attached with a hair tie and a clothing peg. So yeah, that's what I have to go through for you guys.